So picking up where we left off in the previous video, where we were walking through how to calculate the liability that is related to a defined benefit pension plan, we're going to continue with this example and now move into, so now we understand sort of the baseline calculation, right? And we went through, given this information, we went through these 3 steps where we first calculated based on the pension formula what the annual retirement salary would be. Then we did a present value calculation where we brought those retirement benefits back to the date of the retirement. And then the third calculation where we were taking the amount on the retirement date and bringing it back to today's date, which in the example that we were going through was the end of 2019. So open my Excel spreadsheet up. You'll notice that I've deleted the timeline. It's because I'm going to redo it. So we're going to do it together again. I think creating a timeline is a really great way to just sort of visualize what's going on when it comes to the problem. So we're going to redo it. But here's where we're moving into now. Okay, if I jump back to my PowerPoint, where we're moving into now is yes, we calculated what that liability balance should be at the end of 2019. Now we're moving into slide 13. We're moving into what are things that are going to happen throughout the organization's business life that are going to change that liability balance. So as time goes by, that liability balance is going to change. So there are going to be 5 events that will cause the liability, the PBO. So when I say liability, I'm talking about the PBO. What are going to be the things that happen over time that change the value of that liability? So the first thing that can happen is time goes by. So that's a very, very simple thing to kind of wrap your mind around, right? We did that calculation as of the end of 2019. Well, then what happens if Jessica Farrow works one more year? So she works until 2020. That's obviously going to shift some of the inputs in our formula, and we're going to see how on that first Excel spreadsheet. So again, 5 events that are going to cause the liability balance to change. The first event, so to speak, is going to be time goes by. And we'll discuss after we walk through the calculation to show what happens when 1 year goes by. We'll discuss how that relates to service cost and interest cost. But we'll first do the calculation as of 2020 to see just how it impacts the value of that liability. So if I go over to my Excel spreadsheet, you'll see at the top the columns go from G to M, right? And you know that from my classes, that means that there's something hidden in there. So if you click on or tap on the M column heading and unhide, you should be able to see a new set of calculations. So now what we're saying here is, whoops, I want to get out of that draw. Now what we're saying here is what happens if nothing else changes except that 1 year goes by. So that is what we're talking about. You can see right here. If none of the factors change, nothing else changes, but time goes by, what's going to happen to the liability? Again, the first thing I want to do is create a timeline, and I'm going to do it up at the top just because now we have a little bit more room. We were kind of jammed over in the bottom left-hand corner, but now we have this entire top spread that I'm going to make our timeline. Okay, so we're going to first start by saying Jessica Farrow was hired in 2010. That was her hire date. She is expected to work until 2049. That's her retirement date, which would give 40 total years of service. And again, this was all just the factual information that was given to us in the problem. I'm not making anything up as I go. You can see all of that factual information is over there on the top left-hand side of our screen. So again, she was hired in 2019. She's expected to work until 2049. She is expected to be retired for 20 years. So that's her retirement period. And what we are trying to figure out is essentially what is the company promising to pay Jessica Farrow once she's retired. So every year there's going to be some kind of cash outflow, and we want to understand what that cash outflow is going to be. Now, it's not enough. That's just step one, right? We talked about that in our lecture. That's just step one. Then what we're going to have to do is some present value calculations, because ultimately what we want to do is figure out what is the liability that the company has related to Jessica Farrow's retirement as of 2019. That is the date on which we are sort of banking, or not banking. That's the date that we're trying to figure out what the liability is worth, because that's today's date. We have to make our financial statements as of the end of 2019. So we want to understand exactly what is the value of that liability in 2019. So if we break up that first component of our timeline, you can see that the amount of time that she's worked so far is 10 years, which means she has 30 years left. So this is all what we did in our very first lecture. We went through and we outlined the timeline for Jessica Farrow and her retirement. So let's refresh our memory on how we went through these step by step. So step one is using the formula. Let's calculate what is that salary going to be out in that retirement period. So again, we're trying to figure out what is the actual amount that Jessica Farrow is going to be paid every single year in her retirement. We, using the formula, took the salary that she's expected to have in her retirement period, which is $400,000, times the number of years of service, which in 2019 she has worked 10 years so far, and then we multiplied that by 1.5%. That's a percentage that's given to us in the problem. If we do that calculation, we come up with, and again, I'll do it again real quick, 400,000 times 10 years of service so far times 1.5%. What they're saying is we are anticipating to pay Jessica Farrow $60,000 in annual retirement benefits. Okay? Then step two is that $60,000 is way out in the future in her retirement period. And so what we need to do is a calculation that is going to bring that $60,000 annual benefit, right? That's an annuity. We want to bring that back to the retirement period. Now, some of you may be thinking, well, why don't we just do a calculation that brings it all the way back to 2019? The reason we can't do that is because if we essentially brought that all the way back to 2019, what we would be assuming is that Jessica Farrow would also be getting that annuity amount all the way through her years of service. And we know that that's not the case. We know that Jessica Farrow, I just deleted the thing. We know that Jessica Farrow is only getting that annuity throughout her retirement period. She's not getting it while she works for the next 30 years. So when we do these present value calculations, we can only take it back to the date that she's going to actually start getting those retirement benefits, which is 2049. So we're going to bring it back. This 20-year period is what we're going to use in this present value calculation. And again, we did this in our previous video, but we'll do it again right now. Equals PV. My interest rate given to us in the problem is 6%. My number of periods, how long is she expected to receive those benefits? Her 20-year retirement period. Payment, what is the benefit? We just calculated it to be $60,000, and I'm making it negative because for us as the company, this is a cash outflow. There is no future value. There's not some lump sum amount that we're promising to her, and then the type is always going to be 0. If we do that, we say that at the retirement period on this date, lessen that a little bit. On that date, what we're saying here is that the $60,000 annuity for 20 years is equal to $688,195. Okay? Now, step 3 is we need to take this $688,195 and we need to bring it back to 2019. That's the date that we actually need to record the liability. So the last step 3, the last present value calculation equals PV is where we're going to say, again, our rate is 6%. The number of periods. So again, if we're going from 2049 back to 2019, that's 30 years. That's the 30 years that she still has remaining that she's going to work for us. So number of periods is going to be 30. We don't have a payment amount because we already did the payment calculation. Now what we have is this future lump sum amount of $688,000. Excuse me, it's not letting me type on that again. $688,195. And again, I put that in as negative, and my type is going to be 0. If I do that, what we're saying is, as of 2019, this would be the liability that gets reported, the 2019 liability that would be reported on the balance sheet related to Jessica Farrow is $119,821. So again, that's a review of what we talked about in the previous lecture. So now I'm going to change up my color, because what we are going to do is figure out, how does this change if we talk about going to 2020. So what happens if 1 year goes by? The first thing we can do is just visualize this on our timeline. So I changed it to blue in my pen so that we can see what happens if 1 year goes by and we are now here at 2020 rather than 2029. Look what happens to the years of service. Instead of the years of service being 10 years, the years of service are now changing to 11 years, which means the number of years that she has remaining to work is now no longer 30 years, it's 29 years. That is the way that our formula is going to be changed given 1 year going by. So 1 year passes by, it's going to change the number of years of service. It goes from 10 to 11, which means it changes the number of years remaining, which it goes from 30 to now she only has 29 years left. Notice there is nothing that changes about the retirement period. The retirement period is still 20 years. We're not changing any of that. We're just saying that in the current years, 1 year has gone by, which means she's worked for 11 years instead of 10, and she only has 29 years remaining instead of 30. So if none of the factors change, let's go through the 3-step process again. Step 1 is taking the formula that they gave us. Annual salary times number of years of service times 1.5%. Her annual salary is still expected to be $400,000 in the future. And notice this square is highlighted in green. You can see up at the top, green highlights are what I'm changing from the previous calculation. So the thing that's highlighted in green, that's the thing that's changing. Years of service, instead of 10, we now have 11. And then the 1.5% is still the same in our formula. So if we now, 1 year later, it's now 2020, if we now take 400,000 times 11 years of service times 1.5%, what we are now saying is that this annuity is changing from 60,000 to 60, let me do that again, from 60,000 to 66,000. So the more she works, the more her benefits are going to be. So the more years of service you have in, the higher your benefits are going to be. That kind of makes sense, right? If you're working for that company for a longer period of time, then they're going to pay you larger retirement benefits. So we now have a retirement benefit of $66,000. Just as we did in the first calculation, step 2 is going to be, let's bring that $66,000 retirement benefit, let's bring it back to 2049, right? So let's do a present value calculation. That's going to be equals PV. The rate is 6%. The number of periods is still 20. We're not changing anything about her retirement period. The payment is now going to be I think I screwed something up there. All right, let's start over. Okay, perfect. Okay, we're starting over. Equals PV. The rate is going to be 6%. The number of periods is going to be 20. The payment amount, now we're going to use our new $66,000 amount. And again, I'm making it negative because that's a cash outflow for us. We don't have a future value. My type is 0. So now what we're saying here is that the present value of those annuity amounts as of this date is now, instead of $688,195, it's $757,014. The last piece to this is bringing that amount back to 2020. So notice, we're not going to, in the final present value calculation, we're not going to use 30 years as our number of periods. We're going to use 29 years as our number of periods. So equals PV. Our rate, again, is always 6%. Number of periods, instead of 30, I'm now putting in 29. I don't have a payment amount. What I have is this future value of $757,014. And again, I'm making it negative. My type, 0. So now, what we have done is shown that from one year to the next, if all we look at is a change moving from 2019 to 2020, what happens to our liability is that it increases from $119,821 to $139,712. So if we look at each of those, $119,821, and we compare it to the $139,712, if I just subtract the two, it tells me what is the difference between 1 year to 2 year, or between 2019 to 2020. We've increased the liability by $19,890. So again, what we're doing in these next lectures is talking about essentially how does the liability balance change given different scenarios. The first way that it's going to change is simply by saying, well, 1 year goes by. Okay, so let's jump back to the PowerPoint real quick and talk about this. 1 year goes by. That means that that individual has worked for the company for 1 more year, which means that we owe them a little bit more money as it relates to their retirement benefits. So that is going to be called service cost. Okay, so again, 5 events that would cause the liability balance to change. The first thing is simply they worked 1 more year. We're going to call that service cost, and what that service cost is going to do is increase the overall liability balance. It's going to increase it for each year that they continue to work for us. We are going to have additional what's called service cost, and that service cost is going to increase the liability. Second, okay, so these 2 things both relate to just the passage of time. 1 year goes by, how does that affect our liability? Number 1, if 1 more year goes by, that person has earned 1 more year of their retirement, that's called service cost. Our liability is going to increase. Number 2, if we think about it, right, if we look back at our Excel spreadsheet, at the end of 2019, we owed Jessica Farrow $119,821. That essentially means that Jessica Farrow should have that money in her pocket. A liability means that we owe someone money. If Jessica Farrow had that money in her pocket, we would assume that she would be able to invest it, right? So when it comes to, again, the passage of time, the idea is if Jessica Farrow had that $119,000 in her pocket in 2019, she would have earned 1 year's worth of a return on that $119,000. That is going to be what we call interest costs. So again, interest cost is essentially what is the interest that accrues on the previous year's balance of that liability. We simply take the interest rate given to us in the problem and we multiply it by last year's PBO, last year's liability. So if we look at this in terms of our example with Jessica Farrow, we would be able to say, well, Jessica Farrow, and if you see in Excel that little dialog box, if you click on that, it brings up a few of my sort of helpful hints to tell you how to do the calculation. Interest calculated using the beginning balance of the PBO, which is the $119,000. So I'm going to take $119,000, I'm going to multiply it by the interest rate given to us in the problem, 6%. So what we're saying here is that the liability increased by a total amount of $19,890. $7,189 worth of that change is because of interest costs. Jessica Farrow should have been earning interest on that $119,000. Therefore, that's going to be classified as interest cost. Whatever is left over from that change, so $19,890 was the total change from 1 year to the next. $7,189 was the amount of that change that we would allocate to interest cost. Whatever's left over is what we're going to call service cost. So While it is very important to understand the difference between interest cost and service cost, when it comes to how we account for this in our records, in 2020, we would have to make a journal entry to show that our PBO, our liability, has increased from 2019. The way that we would do that for interest cost and service cost is to simply record pension expense, and we would record a credit to the projected benefit obligation. And it would be for the full $19,890.40. So you're probably asking, well, then why did I have to break that up between interest cost and service cost? The reason is because in the footnotes, organizations are required to show how did your liability related to your defined benefit plan, how did your liability change from one year to the next? So even though both interest cost and service cost are recorded as pension expense, the whole thing, the whole shift from one year to the next, all gets included in one journal entry as pension expense. The interest cost and the service cost needs to be disclosed in the footnotes. Disclosed in the footnotes. Okay? So again, it's important to understand that while the total difference, the total shift from one year to the next, we had an increase of 19,890. All of that is related to Jessica Farrow has worked one more year, and we record that all as a debit to pension expense and a credit to the projected benefit obligation. It is important to understand service cost and interest cost because that information is required to be disclosed in the footnotes. So those, right, we said that there are 5 events that might change the value of our PBO, the value of our pension liability. Service cost and interest cost are 2 of those 5. Service cost is the liability is going to increase because Jessica Farrow worked one more year. Interest cost is the liability is going to increase because Jessica Farrow should have been earning interest on the $119,000 that we owed her. So we're going to again allocate that to interest cost. But the total of these two, numbers 1 and 2, the total of those both get recorded to pension expense. So 2 out of 5. In the next videos, we're going to go through 3, 4, and 5 so that you understand what are all of the different events that would cause changes to that PBO balance.